Ladies and gentlemen, boys and girls, your friend Vishal Thakkar is back with yet another video. And today's discussion is capital expenditure versus revenue expenditure. Now, how do you identify whether a money going out or a cash outflow is a capital expenditure or a revenue expenditure? Now, the differentiation is very important here because all expenditure which are of capital nature go to balance sheet and most probably depreciation is claimed on them over a period of time, and all expenditure which are revenue in nature directly go to P&L or income statement and are written off in the current year. So the best way to identify whether a cash outflow is of capital nature or revenue nature is simple. You look at the benefit achieved out of it. If money is going out and the corresponding benefit to the company is of a long-term nature, then it has to be capital expenditure. However, if the money going out and the corresponding benefit is of a short-term nature, then it will be revenue expenditure. So friends, what is long-term and what is short-term? Generally, in common parlance, we can say anything which is greater than 12 months is perceived as long-term. So any expenditure which gives us benefits for more than 12 months, it could be a capital expenditure. For example, buying a new machinery. If the machinery's useful life is 10 years, it is definitely a capital expenditure because it gives a corresponding benefit of long-term nature. However, let's say paying salary to an employee is a short-term benefit because every month we have to pay the salary and the employee will work only for 1 month for a month's salary. So it's a revenue expenditure. However, there are instances of expenditure which are usually in revenue but are capitalized, and also the other way around. For example, books. Books are typically long-term benefit giving items, but however they write it off as revenue expenditure in your books of accounts. Installation charges paid to laborers for installing a new machine are revenue in nature because they are wages. However, because they were incurred in relation to installing a new machine which will give us a long-term benefit, they will be capitalized. So you have to look at the situation and classify the expenditure. Also, most capex outflows are large in magnitude and most revenue outflows are small in magnitude, but again, not necessarily. Most important point here is an expense which is between capital and revenue. It is called a deferred revenue expenditure. So when, let's say, a decade ago, when L&T Cement sold off its cement division to Ultratech Cement, Ultratech incurred a lot of money for advertising. Now let's say for simplicity's sake we assume it to be 10 crores, and you've seen those TV ads where the hat was changed from L&T to Ultratech, the walls were changed, the curtains were changed, stating L&T Cement is now Ultratech Cement. So if they debit the entire 10 crores of advertising in the first year itself, then the first year will show huge loss and subsequent years will show extra normal profit because of the benefit of that advertising accruing to Ultratech over a period of time. So what they did, they used one of the pillars of accounts, one of the basic pillars of accounts called matching costs with revenue, and they converted this revenue expenditure into capital expenditure and wrote it over 4 years. So this 10 crore was broken into 4 parts, 2.5 crores each. First year they put 2.5 crores in P&L and 7.5 crores in the balance sheet. Asset side as a last item, miscellaneous expense to the extent not written off, and they took it to subsequent years. So on in second, third and fourth year, and this is how they forcefully capitalized the revenue expenditure to show a proper trend in profits. Also, there is one very well established pillar of accountancy or GAAP which says that you can only recognize an expense of a particular item in that year in the year in which the corresponding benefit arises. Shortly summarized as matching costs with revenue. So more basics of accounts, more details. Continue to watch our videos and don't forget to subscribe. Finance Tube. Today, let's discuss the 5 key risks of investing through an SIP. Risk number 1. If you take an SIP of a diversified equity mutual fund,